Hello there. I hope that you're doing well. Welcome to the fourth episode of the Swing Trading series. During this episode, we will be discussing long-term trading. And you might be thinking to yourself, what exactly is long-term trading? Because this whole series is about swing trading, right? Yes, that's true. However, there are different ways of swing trading. You can be an intra-week trader, or you can hold positions for more than a few months. And that is what we will be discussing during today's episode. Long-term trading. To me, long-term trading is the following. Positions that last longer than at least 1 month are considered to be long-term trades in my opinion. This is applicable to each asset category, meaning as long as you're able to frame the right narrative and you're able to see what the higher time frame institutional order flow is, opportunities will present themselves in each asset category. That means that these opportunities present themselves in the index futures, in the forex markets, in the commodity markets, and even in the crypto markets. This long-term trading strategy is suitable for traders with a lot of patience. That means that you need to be able to sit in positions for a very long time. This type of trading is great for those of you that have full-time jobs or are very busy in your personal life and do not want to spend a lot of time behind the charts. However, this is also applicable for those of you that are day traders but are ready to next that also have other portfolios for swing trading. Portfolios that are based around you holding onto positions for longer periods of times, such as in stocks or in other asset categories that you are interested in. Pay attention to major narratives being in play. That means that you need to be able to recognize very important larger narratives which are being established in order for these major price swings to occur. Because when you're able to recognize what the narrative is, you can anticipate that they're going to utilize that narrative to reprice heavily on the markets that you're looking at to trade them. Time frame alignment. When it comes to time frame alignment, I suggest you to pay attention to the monthly, weekly, and daily charts. The higher time frame analysis should be made on the monthly and weekly charts, and the execution should be done on the weekly and daily charts. If you go lower than this, the chances are high that you're likely going to be trading intra-week or intra-month swings. However, since we are focused on very long-term positions, we are focused on executing from that daily chart as mentioned. Now let us take a look at an example of Tesla. What you can see is that the Tesla stock has risen towards new all-time highs recently. Notice that it took a while for the market to get going after it formed the low right here and it began the buy side of the curve. I need you to see that this is the sell side of the curve followed by the buy side of the curve. And we are going to specifically pay attention to this repricing higher which took place throughout the end of 2024. As many of you know, in the United States of America, throughout the month of November, a new president was elected. This president was President Trump. Notice that this news was utilized to reprice Tesla significantly towards the upside, paired with a lot of other stocks within the Nasdaq 100. Now, when it comes to this news event, you need to understand that they were literally holding the majority of the stocks inside of tight ranges, so that when the news would come out that President Trump would get elected, you would see this repricing higher taking place. So what is occurring here is that the market is being held inside of a tight range, the news comes out, and then that news gets utilized as a smokescreen to reprice towards the upside, to reprice Tesla towards the buy side liquidity engineered above this high. Notice that when this high was taken out, it was taken out with this very long wick right here. Now, what we will do is we will investigate the delivery that took place, where I can see that the sell side of the curve occurred, followed by the buy side of the curve. What I want you to see is that I've annotated the 2024 open right here. And from the 2024 open, you can see that Tesla immediately dropped towards the downside. You can see that the market immediately repriced lower. Why is this important? Because what is happening here is that for the yearly candle, the 2024 candle, the market is open low. And that right there shows to you that smart money is buying below that opening price. They are positioning themselves long on Tesla. Notice that the market begins to trade above the 2024 open right here, but initially rejects it. We see it retrace into the monthly BC, which got established right here, and we see the market expand above the 2024 open. Notice that the 2024 US elections took place and the market was immediately repriced towards the upside. It was in a rush to run higher. Why? Because that news was the perfect smokescreen for stocks such as Tesla to reach new all-time highs. When we pay attention to the weekly chart then, what you can see is that when we open up for 2024, the market initially ran lower as outlined on that monthly chart as well. Notice that the market ran lower towards this old weekly BC right here. Inside of this weekly BC, we saw the market form a new low after taking out sell-side liquidity, which was engineered inside of that weekly BC. We saw the market consolidate for a while, and we then saw these two imbalances get created right here. Notice that these two imbalances got created the moment that the market repriced above the 2024 open. A retracement occurs, and notice that the market is again consolidating. It's waiting. What is it waiting for? It's waiting for that smokescreen to come out. The smokescreen of the USA elections. And therefore, what you're beginning to see and beginning to understand is that smart money is using that period in advance of the elections to accumulate positions. What you need to understand is that in advance of that smokescreen, which is already scheduled months and years in advance, they're utilizing that smokescreen, which they know will come out, to position themselves long on Tesla. And you see that through this. You see that by them respecting these discount arrays over and over again. So that the moment that price displaces above the 2024 open and the US elections are here, you can see that the market opened low for this week and immediately repriced towards the upside, because this was one big market maker buy model with an original consolidation down here, smart money reversal, buy side of the curve. So when it comes to finding these long-term plays, what you need to recognize and need to anticipate is when specific high-impact news drivers will take place. And we're not speaking about a high-impact news driver such as a, let's say, CPR release or an NFP release, as you know it from the intra-week trading, of course. We're speaking about major events, such as a new US president coming into office, or such as a war breaking out, or such as certain financial changes within the banking system taking place. When you can recognize that these certain narratives are going to get ran with, you are able to anticipate major price swings to occur. And when you can anticipate that these price swings will occur, you can play in on that. And that is what I need you to understand when it comes to finding these long-term plays. This is a beautiful example of a buy program, and this is also why we were so bullish on the indices the moment that President Trump in fact got into office. Because from that moment in time, we were looking for one thing, and that was longs, until proven otherwise. Because stocks such as Tesla, which are very important, were all showing the bullish signatures which we're looking for. And that confirmed to us that the Nasdaq 100 would likely be repriced towards the upside even more. Now, when it comes to the daily chart then, what you can see on this daily chart is that when the US elections took place and the result came out that President Trump would in fact become president again, what you can see is that the market expanded higher. Notice that it displaced through the 300 price level with this imbalance right here. Notice that this imbalance has to function as support on price in order for the underlying order flow to remain bullish. So that means if you did not position yourself long yet in this area in advance of the US elections, what you could have waited for is for the retracement into that daily imbalance, and then you could have looked for longing opportunities in this area. We then saw the market eventually expand higher and it dropped towards that old all-time high. That is, of course, a price where a lot of buy-side liquidity was engineered above. When we pay attention to another example then of a long-term trade, we are going to be paying attention to the weekly chart of the dollar. What I want you to see is that the dollar was consolidating throughout the beginning 2 quarters of 2023, where you can see that the market was just going back and forth, back and forth, back and forth, and it was in a very slow downtrend. Notice, however, that when we saw the market drop lower with these two big weekly candles, we saw the market quickly turn around. And you can see that there were so many green weeks in a row where the door was just in a rush to do one thing, and that was run higher. Why, oh why is this so important? Because I need you to understand that what was taking place was the following: accumulation, manipulation, distribution. And that is the factor what you're seeing here. Or in other words, what you're seeing is that buy side liquidity was engineered above this high, sell side liquidity engineered below these relatively equal lows. We take out the lows, we refer to the high. It's that straightforward, guys. Now, when we pay attention to this narrative then, you need to understand that throughout this repricing lower, every single retail minded trader is thinking to themselves, okay, the door is weak, it's just going to continue dropping. And these final two big down close candles confirm that to them. However, you need to view these big two down close candles as the following. You need to view that as manipulation taking place, so that after manipulation, distribution can follow. Inside of these big two down close candles, you need to understand that there's this final push of the narrative of the door is weak, it's going to come crashing down, the door is going to fail, and this and that. And that's the news which is going to get thrown around, right? Where you can see the media say, oh, the door is so weak, this is the end of the door, it's going to roll over, and the door is going to come crashing down, and this and that, right? And that's the type of narrative which would then get utilized. However, I need you to understand that when the media begins saying these things, right, you should immediately think to yourself, but hold up, wait a minute. Who's actually in control of the media? Who's actually in ownership of the media? Who decides what gets attention on social media platforms? Who decides what news comes out and what news doesn't come out? Who decides what news gets attention and what news doesn't get attention? And I don't want to get into a whole rabbit hole right here and speak about conspiracy theories, right? Because that is simply not like the reason why you're watching this episode. However, I want you to start thinking about these things, right? When you start thinking about why, oh why is it always the case that in advance of key market reversals, it's like the media is just throwing around all of this positive or very negative news to trap every single normal person, average Joe, into believing the wrong thing. And when you can recognize that, and when you can recognize that your technical analysis was already telling to you that when these big two down close candles were forming and the market was dropping lower significantly and the bearish news comes out, when you recognize that, man, it's the perfect confluence to anticipate a smart money reversal forming. What you can see here is that I've annotated the chart and I've annotated these two highs right here to be key buy side liquidity pools. And next to that, you can see that I've annotated these quarterly lows right here. Below these relatively equal lows, a lot of sell side liquidity has been engineered. How do I know a lot of sell side liquidity is engineered below these relatively equal lows? Due to the amount of time it took to form these relatively equal lows. It took 2 quarters in order to form these relatively equal lows. So every single retail mind trader is looking at that as a strong support level for the year of 2023. However, what occurs? Notice that we saw the market drop lower significantly right here, take out these two relatively equal lows, and we then saw a smart money reversal taking place before the market expanded higher. However, there's something which is very important when it comes to these two down close candles. Because what you can see here is that these two down close candles, yes, they began the moment that the third quarter opened up. And that should be a big light bulb. Because for those of you that understand, as I've taught you, time cycles, you will be able to see the following. You will be able to see that the market opened low for this third quarter, took out previous quarterly lows, so those are previous cycle lows, and from there on, you begin to see the signs that confirm to you that a reversal is taking place. What is the market drawn towards? It is drawn towards buy side liquidity engineered on the opposing side of the range, and that is right here, because who is making money all throughout this drop lower? Sellers, of course, and those sellers, they seem to believe that it's just going to continue dropping, right? That at one moment in time, it's going to turn. And when you begin to recognize the signs that the underlying order flow is in fact turning, that is when you need to be wary of the fact that that is likely going to be the case soon when the time is right. Now let us take a look at this line right here. This line right here represents the 2023 open. And what you can see is that the market was trading below the 2023 open and below the Q3 open and below the previous cycle lows. And that is why this was a high probability SMR, where price is trading below key opening times, which suggests to you, yes, the following. It suggests to you that the market is in a deep discount. And when it is in a deep discount, you can anticipate that at one point in time, the underlying order flow is likely going to change from bearish to bullish. And when it does, that is when we can anticipate that we're likely going to see buy-side delivery next. And that is what we were waiting for. And when the signs were present to us that we were in fact turning here, that is when we looked to go long on the door and short on Euro and GU. Here on the daily chart of the door. And what you can see is that when we opened up for Q3, the third quarter, we in fact saw the market displace towards the downside and it quickly began running over. Notice that we spent some time below the relative weak lows of those quarterly lows right here. And we then saw the market eventually turn around. And we saw it begin displacing higher. Notice that this BC right here formed whilst the market repriced above the price level of those relative weak lows. Why, oh why is this important? Because it tells you that this is a crucial imbalance to monitor, whilst the market is also repricing above the first few imbalances near the SMR, which should have functioned as resistance on price if the underlying order flow would remain bearish, right? That is what I've taught to you within the 2024 model series, within the order flow lectures. We see the market retrace into that BC and it finds support there. Notice that we then see an expansion higher taking place. And from this moment in time, you should immediately think to yourself, all right, who has been making money for all these months now? Short sellers. And therefore, we can anticipate that when the time is right, that we are likely going to draw towards all of the buy-side liquidity resting above these highs right here in the form of trendline liquidity and clean highs, of course. We see the market expand higher and it trades above the Q3 open. Next to that, you can see that we see the market trade above the opening of 2023. And we see the market trade above this high right here. Now, why in particular is this high so important? Because this high was the high of this retracement on the sell side of the curve, where you can see that the market expanded lower, formed this low, retraced, and then had its final push towards the downside. Now, this has to do with market maker model symmetry, which I'm going to teach to you. When you know that the market is drawn towards buy-side liquidity resting above this high, or for example this high, yes, we can utilize any retracement on the left side of the curve, such as here, this retracement higher, as a range to monitor once the market trades above it. So we can anticipate that this range is going to function as support on price once traded above on the right side of the curve, when we know that the time is right for that buy program to unfold. And that is why it's so important to recognize the smart money reversal right here. When you can recognize the smart money reversal and you know that this is point A of the buy program, you can anticipate that the market is not going to stop expanding higher until it completes its market maker buy model, until it reaches point B. We see the market retrace into that old retracement leg on the left side of the curve, and notice that it trades back into the Q3 open. The market finds support here and we see it expand towards the upside, and we see the market take out the buy side liquidity resting above this high. Notice that during this expansion leg higher, an imbalance formed right here. And now this imbalance has to function as support on price in order for the underlying order flow to remain bullish. Why? Because this imbalance formed throughout the expansion leg into this buy side liquidity pool objective. We see the market eventually retrace into that imbalance and it expands higher once more. Notice that another imbalance forms right here, a tiny one. The market retraces into that imbalance and into this old high before expanding towards the upside quickly, drawing towards the buy side liquidity resting above this high and creating a new yearly high. This is the market maker buy model done on the door. Now you might be wondering, where can we look for buying opportunities on the door? Well, the first opportunities present itself all the way in this area, below those quarterly lows, of course, inside of that SMR. Next to that, buying opportunities presented itself in every retracement towards the downside which occurred. For example, here, or here, or here, or here, or here, until the drawing liquidity of this high was met. The moment that that drawing liquidity got hit, yes, from that moment in time, you need to let go of the idea of the following. You need to let go of the idea of simply just, okay, we're not going to continue higher anymore. Just let go. And when that is the case, be content. And if you missed out on the move, you missed out on the move. And you need to wait a few more months before the underlying order flow becomes clear again for such a mega move to take place. Notice that this move originated from the 100 price level, the door. Now, when we pay attention to intermarket relationship then, inside that smart money reversal, what I want you to see is that on the left you can see the door and on the right you can see the euro. Notice that the door created a higher low below those quarterly lows right here, whilst euro created a higher high right here. And that right there is a current correlation, because that signals to you that a smart money reversal is in the making. Because what is taking place is that SMT is forming here, where the door should have made a lower low, whilst euro made its higher high. And it didn't happen. So that shows to you that the sell side of the curve is coming to an end and that the buy side of the curve is going to take place soon. The time is right for the market to begin to expand higher soon. And that is what you see, of course, on euro be utilized for that repricing lower. Now, let us pay attention to the euro chart then, because here we're on the weekly chart of the euro. And what you can see on this weekly chart of euro is the following. You can see that I've annotated the 2023 open, I've annotated the Q3 open, and next to that you can see that I've annotated sell side liquidity resting below this low and buy side liquidity resting above this high. Notice that when we open up this third quarter, we saw the market immediately open up and run up higher quickly. Notice that the market took out buy side liquidity resting above this high, and we saw the market eventually form a smart money reversal here before displacing through the imbalance which formed during this final leg higher. Notice that a weekly CB formed right here, and the moment that euro retraced into that weekly CB, whilst the door was showcasing to you that it was likely going to change from sell program to buy program as well on the higher time frames, this was already a first shorting opportunity right here. Why? Because we displaced through the buy side liquidity pool, or through this old high, I should say. We displaced through this imbalance, which should have functioned as support and price if the underlying order flow would remain bullish. We saw a bearish array get formed, and we saw the signs that confirmed to us that the SMR was in play, and we're trading above the Q3 open, which opened high, and we're trading above the 2023 open. So what do you know? You know that we're of course in a very deep premium for euro, whilst the door is in a very deep discount. So the door is likely going to turn around for the remainder of the year, whilst the euro is also turning around for the remainder of the year. And that right there is absolutely beautiful to understand, because that is how we can utilize intermarket relationship. Now, when we pay attention to the repricing which took place afterwards, you can see that euro had a very bearish remainder of the year, where you can see that there were many weeks in a row where the market was just expanding towards the downside. Now, when we pay attention to the daily chart then, what you can see is that I've annotated that weekly CB, and next to that I've annotated some different arrays as well. What I want you to see is that when we opened up for this third quarter, we saw the market expand towards the upside quickly and multiple imbalances were created. We saw the market expand heavily above the buy side liquidity pool of these relative vehicle highs, and this was a market maker buy model which was being completed. Original consolidation, sell side of the curve, buy side of the curve. We saw the market expand above those relative vehicle highs, and we eventually saw the signs of a smart money reversal forming in this area, where you can see that SMT took place and the market began violating the imbalances which formed on the left side of the curve right here. Now, this is where a lot of pattern traders get mixed up, because a lot of people, right, they seem to believe that whenever an imbalance gets created, that imbalance has to function as support and price, because then the market is just going to expand higher, right? They think that you should go long right here. Breakout artists would love this, right? They see this as, oh, euro is very strong and the door is very bearish. However, here comes the thing, guys. You need to understand that an imbalance can also show to you manipulation. So what you're seeing is you're seeing this very quick expansion higher, and you're seeing these imbalances get created. But these are not imbalances, yes, that we can utilize to continue looking for buying opportunities. Instead, we are going to utilize these imbalances as inversion for value gaps on the right side of the curve, which is likely going to take place soon. What you see is that the market displaces through this highest imbalance right here, and a CB forms. A retracement takes place into this CB, and this is where institutional order flow entry drill is taking place. Where I can see that the market is just stepping into the CB right here. The wicks go in it, but notice how quickly the market is rejecting it. That right there shows to you that there's an urgency for the market to expand towards the downside. The weekly CB gets created, and you can see that the market retraces into that, and we then see an expansion leg lower occurring. Notice that the market now displaced through the Q3 open and through an imbalance which formed right here on the daily chart. Notice that this imbalance now has to function as an inversion for value gap in order for the order flow to remain bearish. Notice that the market taps that imbalance multiple times, and this is where intra-week traders should smile, because they should know by having watched the previous episodes. If you didn't watch the previous episodes yet, you shouldn't be watching this lecture, guys, by the way. Like, I honestly don't understand why people go from the end of a series to the beginning of the series. It's, in my opinion, it's stupid, right? Like, just follow along with the structure that I'm releasing everything in, because I'm slowly and gradually increasing the level of difficulty. The same as I'm going to do within the 2025 model series, where I'm going to simply begin at a certain foundation, or begin establishing a foundation, and then on top of that foundation, I will build and build and build. Why do you think I began with just the intra-week trading when it comes to swing trading? Because in general terms, that's usually the easiest form of swing trading. However, we're now looking at very long-term plays, and by the end of this lecture series, you will receive schematics which you can utilize in order to find these big swing setups. And that is going to be the final lecture of this series, but that's for then. Anyhow, an intra-week trader would utilize this daily BC as an inversion to value gap as his point of interest to look for smart money reversals within market maker sell model fractals. Because when he recognizes smart money reversals occurring within market maker sell model fractals, around that Q3 open and around that daily BC, he can look for lower time frame opportunities to present themselves. Notice that the market eventually expands towards the downside and expands below this down close candle. The moment that the market traded below this down close candle had to function as resistance on price, because this down close candle, yes, was the low of Q2. Yep. And that should be a very big light bulb for many of you. That's a quarterly low which got traded through and should now function as resistance on price in order for the underlying order flow to remain bearish. And next to that, you should understand that this down close candle is a bearish breaker, where I see a high, low, high, lower low. Market retraces towards the high of the down close candle, just wicks above it, but notice that the bodies keep on closing below 50% of that range and below the 2023 open. That right there shows to you that the market is likely going to expand lower soon. Is it possible to enter this rate when the drawing liquidity is this price level? It's possible. However, the higher we can look to short, the more ideal the position is, of course, because the more in the premium we short, the more room there is for potential profit. Is this a pyramid opportunity? Yes, absolutely. So with that being said, I want to thank you for watching this 4th episode all the way to the end. I hope that this episode has given you some insight on how to anticipate these very large price swings utilizing scheduled news events next to sound logic of understanding, all right, what is the year doing so far? What are the opening prices telling to us? And what is IPDA doing in general? Is it creating the narrative that we're very bullish or bearish? Because when we have that narrative established that the masses are adhering to, we can look to do the opposing. And that right there is a mindset that you need to be able to adopt. Where the majority of people would choose to go to the left, you would have to choose to go to the right. Because that is manipulation which we can recognize, that we can look for the distribution to unfold. We don't look to participate where the dumb money is participating. Well, we actually do, but we do the opposing of what they're doing, right? We're trying to align ourselves with the smart money. We trade as smart money does. And that is the perspective which I'm teaching you throughout my mentorship. So I want to thank you for watching this episode all the way to the end. If you want to investigate what I've shared with you, I suggest you to go to the weekly and monthly charts of the markets that you're interested in, whatever asset class you choose to use. Investigate these very major reversals that occurred, and then research the news which was taking place around those reversals, and you will begin to see the alignment with those big narratives and, of course, the technical analysis. Be safe, and I look forward to catching up with you in the next episode. I want to wish you good luck with your studies.